The broadcast is now starting. All attendees are in listen-only mode.
Okay, hello everyone, and thanks for joining me tonight to talk about Position Sizing 101. Hopefully you can hear me okay. If you can't, you'll just let me know. Or I guess if you can hear me, just type a Y in. Okay, I know some of you want to watch the presidential debate that starts at 9 o'clock, so probably in the first half hour I'll get through a lot of the meat of the presentation. And I am recording it, and we'll send out a link probably tonight, late tonight, so you'll be able to watch the rest of it. So again, thanks again for joining me, and thanks for joining me tonight when it was scheduled for last week because I had to postpone it. I was having some internet connectivity problems, and so I didn't want to try to do a webinar where it was cutting in and out. So that's the reason we delayed it. So tonight we're going to talk about Position Sizing 101. I'll try to keep it pretty simple and hopefully just go over some of the concepts and some of the ideas, and hopefully it'll spur you to thinking about your own systems and your own trading and some of the things you can do, because it's really a wide open world when it comes to position sizing. So okay, we're going to first, for those of you who don't know me, I'll just do a quick bio of myself. Then we'll talk about Position Sizing 101, and we're going to be using the trender systems that I have as some examples. And so at the end, I'm going to have a special offer on those. So if you think you might be interested in trading that system yourself, stick around for that. And then we'll have probably about 15 minutes or so of Q&A. So I'm a full-time trader, and I underline that because I think that's the most important thing. I'm not a full-time system seller or marketer or anything like that. I trade, and that's what I really do. I do this because I get a lot of questions from people throughout the trading day, and rather than answer people individually, sometimes it's easier just to talk to a whole bunch of people. And based on the interest that people have expressed in these webinars, I think that's kind of going pretty well. So it gives me something to do besides just trading, because that can kind of get a little monotonous and a little boring. So a full-time trader, and I finished first or second place 3 years in a row in the World Cup of futures trading, and each of those years I had over 100% return. So that was the same contest that Larry Williams way back when turned $10,000 into over $1 million. So it's a pretty prestigious contest, and I was able to do pretty well in it for 3 years. Okay, so I'm going to be showing some numbers of things, so I want to put up a disclaimer that basically don't trade if you don't have the money to trade with. Trade with money you can afford to lose. Past performance is not indicative of future results, and all the results I'll be showing are hypothetical, and there's limitations to those. And hopefully a few weeks ago you saw my hypothetical performance webinar where I talked about some of those reasons. So any time you see any results from any trader or any marketer or any system seller or anything that isn't your own personal account, you have to treat it as hypothetical, because it didn't happen to you, and it may not happen to you even though it happens to somebody else. Okay, well, what I hope to teach tonight is just to go over 5 simple position sizing methods, and then try to answer the questions. The first question is there a best position sizing method? And the second question, can you get reward without risk? And then we'll talk a little bit about what position sizing cannot do, and I'll touch on where to get more info, because like I said, this is just going to be an introduction. It's not going to be super in-depth or super complicated things. That's why I called it Position Sizing 101. And there's a possibility maybe down the road I'll do a 201 or 301 if people are interested, because there's a whole lot you can do with position sizing, but there's also things it cannot do, and we'll touch on that in a little bit. So that's kind of our roadmap of where we're going tonight. Hopefully I'll be able to give you good info on each one of those things. So the 5 techniques that I'm going to bring up, these are 5 of literally millions of different ways to position size. And the one trap a lot of people fall into is it's very easy to optimize your position sizing method, and you might not even realize you're doing it, because at least with most strategies, when you back test strategies, you know you're optimizing, because a little window comes up and it says, hey, you're optimizing, what ranges do you want for these variables, and it's pretty easy to see it's running through 1,000 tests. This is a little trickier because you might be optimizing if you try all 5 different techniques, or 10 different techniques, or even with a percent risk system, if you try 10 different values of it and take the best one, what you've done is you've just optimized. And it's something to watch out for, because just because something looks good on an equity curve in the past, people will tend to think it's going to hold up, and that's not necessarily true. The second major point with this is there's really no right way. There is no 100% correct way where if you looked at the way somebody was trading with position sizing, you wouldn't be able to say you are doing it absolutely the right way or you're doing it absolutely the wrong way. It really depends on the individual. It depends on your goals, both for return and for allowable drawdown. There's obviously some emotions that get in the way, because there's some position sizing techniques that will get you in a hurry up to a huge position that emotionally you might not be able to take. So there's really no one right way to position size. And probably the biggest thing is that if you do it wrong, if you position size wrong, you can easily blow out an account. And you can take a strategy that's a winning strategy and you can lose with it. And a good example of that is not one of the techniques I'm talking about, but there's a technique called fixed ratio system, position sizing system, that actually the person who implemented it wrote a book on it. And the interesting story about that is, if you read the book, it looks like it's this great, pretty aggressive position sizing system. But what most people don't know is that this particular person actually blew out at least one account that I know of, probably more, trading this method. Now, he might have had a good sound strategy, and he might have done okay had he just traded one contract, but by using an overly aggressive position sizing, he basically blew out his account. So position sizing can take a winner and turn it into a loser. And if you learn nothing else from tonight than that, that's an important thing, because most people only look at the upside. They look at this great equity curve that just goes, exponentially up. They don't look at the downside possibility. But the other related topic to that is you can't take a losing strategy. You cannot take a strategy that over the long run just trading one contract is going to lose and turn it into a winner with position sizing. And the way to think of that is true is, imagine all the people that play roulette in Las Vegas. There's no advantage to position sizing with roulette because it's a losing strategy, unless you're the house. But for the people gambling, they can try all sorts of position sizing techniques, and believe me, most people have tried different techniques, and no one's walked away from the roulette table a long-term winner using position sizing, because they're applying position sizing to a losing technique, to a losing strategy. Okay, so there is a question that came up here, so it's a good time to talk about what is position sizing. Position sizing is really how much how many contracts, how many shares are you going to put to a particular trade. So, for example, the way I develop strategies for futures, I always assume one contract, and so I apply no position sizing. So it's one contract every time there's a signal you buy or sell. And so position sizing might tell you, well, if you have a $100,000 account, based on position sizing X, you instead of buying one contract, you want to buy 10 or 15 or 4 or whatever. So that's position sizing. So it's the amount that the size of your position that's based on whatever criteria, position sizing criteria you use. So the five ways I'll talk about today, and again, these are 5 ways of about 1 million different ways when you look at all the little iterations you can do. First one's just a fixed size. So that's the one I just mentioned. You trade one contract all the time, regardless of the amount you have in your account. Second way is you trade one contract per a certain dollar amount. So let's say $25,000. So if you have $0 to $25,000, you're going to trade one contract. If you have $25,000 to $50,000 in your account, you'll trade 2. If it's 50 to 75, you'll trade 3, and so on and so forth. Percent risk, and I'll show you an example of that. Kelly Criterion, this was a more mathematical way of doing it. It's kind of risky, but I'll talk about that. Martingale, the 5th one I'll talk about, and I just kind of threw that one in there. I don't necessarily recommend any of these. Some of them are pretty risky. Number 2 is probably the most popular because it's easy to understand, it's easy to follow, it's pretty simple. You know, if you have a $10,000 account and you want to trade one contract with every $10,000, if you double your account, you double the amount of contracts. That's the way that one works. So what I'll do is I'll go over each one of these. And again, like I said, these aren't the only ones, and I'm just trying to give you an overview of what kind of things are possible, and then we'll kind of get into how to analyze and look at things with different position sizing. So the rules for the fixed size are you always trade one contract. So you can see in this chart across the bottom I have increasing equity, and on the vertical axis is the number of contracts you trade. So really you're just trading one contract regardless of equity. Is it a good method? We'll see. Here's one contract per a certain dollar amount. And so as you hit these different dollar amount thresholds, your contracts jump up from 1 to 2, 2 to 3, 3 to 4. So it's kind of a stairway type effect. Again, that one's pretty simple. Percent risk. Now this one, there's a couple different ways to do it. I'm using the average loss, so your average trade. Some people use the maximum loss, and actually if you want to be a stickler about the percentage loss, you would want to use the maximum loss rather than average loss. But what you do here is, let's say you want to risk 2% of your equity on any trade. So you multiply 2% times your equity, you divide it by your average loss, and then you get the number of contracts. So this can be all over the map depending on how much you risk. You know, some people only risk 1 or 2%. Some people will risk 10%. Again, there's no right way, there's no wrong way. It's more what you're comfortable with. You know, if you risk more per trade, your chances of getting blown out, you know, and losing all your money go up, but your chances for big gains also go up. Okay, the fourth one is a little more complicated. I put the formula up here. It's called the Kelly criteria. It's based on a gentleman who worked for the phone company way back when there was Ma Bell, or I think it was Ma Bell he worked for, but it's based on signal to noise ratios and that kind of thing, information basically over phone lines. And without getting too deep, somebody took it and applied it to trading. And really what you do is you take your average win percentage and the ratio of your average win to your average loss. And what this will do is it will give you the recommended amount of risk per trade that you should take on, percentage-wise. And the nice thing about it is it's pretty aggressive compared to like a fixed risk that we just talked about, a fixed percentage risk. But the bad part about this is it's probably overly aggressive for most people, and it tends to you tend to blow accounts out with this. But again, it's just another way of doing it, and that's why I wanted to bring it up. And then the last way I want to talk about is a Martingale system. And what this does is every time you have a loss, you start out with one contract, and if you have a loss, your next trade you'll trade 2 contracts. And if you have a loss again, you'll trade 4, then 8, then 16, then 32. And eventually you're going to win, hopefully. And then when you do, you go back to 1. So theoretically, you could be trading 1,000 contracts, which obviously you'd have to have the right account size and meet the margin requirements for it. But the theory is if you have an unlimited amount of money, you eventually will win with this system, which is true. The problem is nobody has an unlimited amount of money, and if you did, or even close to that, well, why would you even bother risking it all trading? So, but it is an approach. This one of all the 5, this would be the least recommended one, but I wanted to show it as an example. Okay, so now what we'll do is we'll take these 5 different techniques and apply them to a couple systems, and then look at the results and see what we can see. So the ground rules, what I'm going to do is I'm just going to use my Trender Gold and Trender Euro systems. I'm going to use the walk forward and real-time history of trades for those. I'm going to use them separately, even though those systems trade together. You know, they're complementary systems. I'm going to separate them. I'm going to assume you could trade up to 100 contracts, which I really need for the Martingale type approach. I'm going to run the analysis from 2006 to now, so about 6 years. And I'm not going to stop trading unless a drawdown of greater than 90% is hit. And the reason I'm doing that is, I mean, that's basically going to nothing. I don't think anyone out here would ever use that, but it's good for just illustrating some specific concepts that I want to show. So that's why I use such a big drawdown. So the system, again, I mentioned how you can't take a losing system and put position sizing on it and get it right. So the system, based on just a single contract, is definitely positive expectancy for both gold and the euro. You can see those blue lines, the light blue and the dark blue. I mean, both systems are going up and to the right. There's definitely drawdown periods, but over time these are positive expectancy systems, so it's realistic to think that position sizing is a good thing, might be a good thing depending on how you do it. So that's where we're starting. Okay, so here's a Trender Gold system, I started with $25,000 in equity and ran it through the last 6 years with each of the 5 methods. Now you can see a couple things. The first thing, you can't really see the blue line because it's I believe the yellow line is right on top of it, which is 2% risk. The green line looks pretty good except for the huge drawdown, and eventually you can see the flat line over towards the end where it had more than a 90% drawdown, so it stopped trading. So it basically just went flat. And you can see the one that does the best, at least if you're just looking at net profit, is the Martingale, which again, kind of makes sense because it assumes you have unlimited money to trade with this. But it also endured over looks like almost $1,900,000 drawdown. I don't know how many contracts it was trading, but it was huge. Almost a 90% drawdown. If it had been, it would have just stopped. But then it recovered and made new highs. And that's typical of a Martingale. Chances are in the real world you'd never trade the green line or the red line. But and even the purple line, you might not want to because of the high drawdown even with that. But that's the first step in doing any analysis, is you just look at what the equity curve does. The other interesting thing is it depends on your start equity. So if I change it to 50,000, you can see the red line actually is exactly the same. The scale might have changed, but its results are the same. But now you see the Kelly system changes a little bit, although it still ends up blowing out its account. Think about trading something like this. You're gaining or losing hundreds of $1,000s on each trade. It's crazy. And you can see the first 3, the one contract, if I add a contract over $50,000 and the 2% risk, are all pretty tame in comparison. I can do the same thing with the Trender Euro system, and what's interesting here is that the results are a little bit different, where this one, the Martingale system, basically blew out early on. The Kelly system blew out about a third of the way through, and it turned out your best system was actually the one where you add one contract every $25,000. So at 50,000 you're trading 2, at 75, 3, at 100,000, 4. Pretty simple. And you can see even with that one you get some pretty significant drawdowns as you go up in time, because you're trading this over a period of 6 years. And then again, if you change the equity on it, you get some completely different looking curves. So hopefully you can see a couple things here. One, depending on the system it is, one of the position sizing systems will always look the best, but if you apply it to a different system, it might not be the best. And if you change the starting equity, even then you might change what's your best system. And these are important things to realize. And because, well, here's the general conclusions. First, if you change the method, depending on the method you use, you can show enormous account growth. I mean, look at that Martingale system. It was off the charts for gold. So it was huge account growth. But the flip side is it was very easy to blow out accounts with Martingale and the Kelly method. Third point, and I didn't show it on the chart, but with the percent risk method, if it's low enough, you might not be able to trade at all. It'll tell you the number of contracts to trade is 0, because you're risking too much of your account equity on any particular trade to trade at all. So that's something to keep in mind. It might be if you have a $50,000 account and want to trade 2% risk, you're looking at basically a $1,000 loss. Well, if your average loss for a system is $1,500, it's always going to tell you never to trade. So it's an important thing to know. And then the last point with these charts is there's never a one-size-fits-all solution. So I just showed it. Different starting equities yielded a different best case. And different strategies, when we looked at the Trender Gold and the Trender Euro, just taking those differences gave you different best cases. So hopefully you can see by just varying the inputs, you can, with the same position sizing, you can get a lot of different results. And hopefully that's kind of leading you to think that, hey, it's really easy to optimize and get something that looks good that going forward might not work that good. And that's a key point to keep in mind. So one of the other things you might be wondering, especially with some of those high-flying position sizing techniques where you can, quadruple your money every year, is can you get risk without reward? And because that's really what you're looking for with position sizing. You're looking to get a lot more reward out of things without additional risk. One way to measure this is what's called the MAR ratio, which is just taking the annual percentage return you get from a system and dividing it by the max percentage drawdown. And what you want is you want to get this as high as you possibly can. So a MAR ratio of 10 is obviously a lot better than a MAR ratio of 2. And if you can do this with different position sizing, then in effect what you're doing is you're getting extra reward for the same amount of risk. So is it possible with these techniques and these systems? Well, one way to look at it is to actually plot it. And so here I've plotted for Trender Gold for different starting equity amounts, the return to drawdown ratio, this MAR ratio. And a MAR ratio of 1 is considered by most commodity trading advisors to be a pretty good ratio over a long enough period of time. So let's say over 3 or 5 years, if you have a 10% drawdown, if you have a 10% annual return, that's a pretty good ratio. That's what the professionals use. There's obviously people out there who do better. A ratio of 2 would be considered really good. But even if you can get a ratio of 1, you're doing pretty good over time. And so what that would mean, if you can withstand a 30% drawdown, you might be able to get 30% of your returns. So here are the results for the Trender Gold system. And the important thing, there's some bouncing around, and that's due to a couple things, both the equity amount and the fact that you have to jump from one, let's say trading 1 contract to 2 contracts to 3. It's not smooth. But you can kind of see that no matter what you do, you don't get a whole ton of difference, and you actually don't get a whole lot better than just trading 1 contract, which is the blue line, which then becomes, you can see on the left it becomes hidden, and on the right it becomes hidden, but this almost says trading 1 contract gives you your best ratio of return to drawdown. And then if you look at the Euro system, and this is the Trender system, you get different results for different position sizing. So again, the position sizing technique definitely depends on the system that you apply it to. And here the results vary a little bit more, but still you can see, for example, the blue line, the pink line, and the yellow line all basically are about the same. So almost no matter what position sizing technique of those 3 you take, you can't really get that much better return to drawdown. Now, it doesn't mean you can't get a better return. Of course you will if you trade, the more aggressively you trade, the larger size you trade, you'll get a better return, but you can also get a bigger drawdown. So that's the key to keep in mind. So just looking at all this data, and I've probably gone through it pretty quickly, but again, my point was just to kind of wet your feet with just understanding position sizing and some of the things you can do with it. The best method for position sizing, if you're looking at just return to risk, really depends on your starting equity and also the strategy. And there's no free lunch, and that's important to know. At least with the cases I'm looking at. Basically what it's saying is if you want bigger returns, you have to be willing to accept bigger risks. Okay, so that's an important one to know. Now, is there a position sizing technique that would give you better returns for a given risk? Probably. But again, you run the risk of optimizing for a particular strategy, so you got to watch out for that. But you may wonder, well, okay, the examples you showed, that I just showed, didn't say, say you can't do that, but is that generally the case? Can there ever be what I'm calling a free lunch, which means extra reward for the same amount of risk? The answer is yes, there can. And the easiest answer to that is just think of a system that can return 100% a year or more. If you put position sizing to it, you can get annual returns probably in 500,000%. And the worst you can ever do is a drawdown of 100%. So you can't get any bigger than that. So you have unlimited returns on the percentage side, but a limited risk. So if you take risk reward divided by risk, that number is going to get bigger, and that MAR ratio can get very large. But the downside to that is, with the more aggressive position sizing, yes, you can do a lot better, but your chances of getting a drawdown that will just knock you out are a lot greater. So that's something to watch out for. Okay. Hopefully, I see a couple people have dropped out to go to the debate, so just got a few more slides here, and then I'll do some questions. And maybe we'll be able to wrap up a little bit early for anybody who wants to catch the presidential debate. So this obviously is just the beginning. We only looked at 5 methods, and like I said, there's a ton of different ways to position size, especially when you look at all the little iterations. Percent risk, for example, you could do 1%, 2%, 3%, up to whatever, 20%. So right there's 20 at least different ways to do it. The other thing we didn't look at, I didn't even mention really until now, is position sizing for a portfolio. So I separated Trender Gold and Trender Euro as just standalone systems. Well, the reality is, the way I personally trade them, I trade them together, and there's different ways to trade 2 systems or 4 systems. It gets a ton more complicated, and again, there's no right way to do it, but there's definitely ways that you can be more aggressive when you're trading a portfolio of systems. The other thing we didn't look at was something I always use in looking at position sizing, is the Monte Carlo analysis, which basically is a simulation technique. And that helps make better decisions, because the curves I just showed were the history as it occurred. Well, that doesn't mean the history that occurred is going to occur the same way. Maybe the trades are representative of what will occur in the future, but what if you had all your losers up front, for example? If you run a simulation, sooner or later there'll be a case like that, and that's when it's good to look at position sizing under a simulation, because it'll give you your chances of blowing out an account. So it might be that when you apply position sizing to any equity curve that you have, you'll get a result, but if you scramble the trades up, that might be a terrible position sizing method in general. So that's something to watch out for. And again, that's a topic of its own. It's way advanced, and I didn't want to get into it here. But really, when it comes down to it, the bottom line is you could easily spend as much time just looking at position sizing as you could developing your strategy in the first place. Probably spend more time doing it, and you might not get better results in your trading overall by spending a ton of time on position sizing. So just wanted to throw that out there. So there's a couple good sources for more information. I was looking through books in my library of what was good, and two popped out as probably being the best as far as explanations and examples. One is Van Tharp's book, The Definitive Guide to Position Sizing, and that has 31 different models. So we went over just 5. He has 31, and then there's a lot of little iterations on them and little variations. So he probably has over 100 in that book. Another one, a simpler one, is The Universal Principles of Successful Trading, and that had some pretty good explanations of position sizing in Chapter 8, which is about 60 pages, so it's not as in-depth as Van Tharp's, but it's probably a good place to look and read about it. So the key takeaways with all this is, in general, reward and risk go together. So, don't be thinking that you can just throw position sizing on any old strategy and it turns into a gold mine. It's not true. And some people will tell you it's true, and it's really not. There's a possibility it could work that way, but chances are for most people and most systems, you can't get something for nothing, is the way I look at it. And the second thing is there is no best method. As I alluded to, there's a book out there on one particular method, and if you read that book, boy, you'll think that's the only method in the world to use. Well, it's good under circumstances, just like any other position sizing method, but it's not necessarily the best. The third point is it's very easy to optimize results. I've mentioned that a bunch, but it's very easy to trick yourself into thinking you've applied position sizing to get something great, and all you've done is curve fit to the past data. And the fourth point is, if you're aggressive with position sizing, you can easily blow out your account. It's much easier than you think. So, all things being equal, what I always recommend is just trade small, and especially until you've traded a system for a while. I still have some systems that I've been trading for a while that I still trade with basically no position sizing applied to it, because I just see the equity swings and I just don't want to get too aggressive, because you run the risk of huge drawdowns. So just be careful with position sizing, because it can really kill you.